Hey everyone, let's jump right into it. I'm putting on my equity research analyst hat today because honestly, we have a massive market shifting event to audit. We're diving deep into the raw data behind the newly formed Vivemark Residential, this absolute real estate titan born from the mega merger of Equity Residential and Avalon Bay. We're doing no hype, no fluff today, just an objective, forensic look at the numbers to see if this residential behemoth is built on solid bedrock or, a foundation of financial sand. But real quick, before we begin parsing the filings, please note the following. Disclaimer. This is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism. Okay, let's dive into this. $70 billion. That is the staggering enterprise value of Vivmark Residential at close. And when numbers get this astronomically large, the market tends to just nod along, kind of assuming bigger always means better. But as an investigative journalist of financial statements, a number this massive immediately makes me ask a simple question. Is this mega merger a strategic triumph, or is it a value-destroying trap completely disguised by sheer scale? Let's find out. Part 1. The mega merger catalyst. To figure out if this is a strategic triumph, we really have to look at the catalyst itself. To understand the mechanics of this all-stock merger, let's just look at the post-merger ownership structure. It's basically a dead heat. We're looking at a 51% stake for Avalon Bay shareholders and a 49% stake for Equity Residential shareholders. This combined portfolio creates a sprawling empire. We're talking over 180,000 residential units across 600 communities. It's a true marriage of coastal market dominance that blends urban and suburban footprints perfectly. But as we all know, scale alone absolutely does not guarantee profitability. Just look at the objective data presented here. Management is out there touting about $125 million in run rate net of tax synergies within the first 18 months. Sounds great, right? But you have to weigh that against the immediate heavy lifting costs of the merger. We are talking about an estimated $750 million in one-time expenses. That's real estate transfer taxes, massive legal fees, and transaction costs. It's a staggering upfront bill that is going to severely weigh on their operating results well before those long-term synergies ever see the light of day. Part 2. Analyzing the debt gauntlet. Now, what's really interesting about this slide is, to understand Vivmark's true risk profile, we absolutely have to audit the legacy debt they're inheriting. This right here is a direct pull from EQR's actual 10Q filing. You're looking at over $7.4 billion in fixed-rate debt alone. Look closely at those maturity dates and the interest rates. A huge chunk of this consists of unsecured notes locked in at relatively favorable rates from a previous economic era, some extending all the way out to 2047. So absorbing this legacy fixed-rate debt actually provides a really crucial layer of stability for the new company. But of course, not all debt is fixed. Before we look at the variable side of things, I want to quickly define a crucial piece of financial jargon for you, SOFR. It stands for the Secured Overnight Financing Rate. Put very simply, it's the benchmark interest rate that banks use to price dollar-denominated derivatives and loans. Basically, when SOFR goes up, the cost of their floating rate debt goes up right along with it. And here's exactly why that matters for Vivmark. This filing shows the unconsolidated debt instruments tied directly to SOFR. Notice where this floating rate exposure actually sits. It's heavily concentrated in their development projects, places like Madeira Bridle Trails and Madeira's South Shore, bearing interest at SOFR plus a 3% or even 3.25% spread. As investigative analysts, we have to recognize that while their fixed debt is a great shield, these floating rates on construction and development projects mean macroeconomic rate hikes directly and painfully impact their future expansion costs. So what's the final outcome of this whole debt gauntlet? Well, S&P Global Ratings estimates the combined Vivmark Residential will carry an adjusted debt load of roughly $18 billion to $19 billion. That's huge. However, despite that massive number, S&P expects them to maintain a pretty conservative leverage policy of about 5x adjusted debt to EBITDA. Add in $2.5 billion revolving credit facilities for liquidity, and you basically have a balance sheet that is highly levered in absolute terms, for sure, but structurally sound relative to its massive earnings power. Let's move to and see how this builds. Part 3. Hidden red and green flags.
So, digging past the headline numbers, we find these critical metrics buried in the footnotes that mainstream coverage almost always skips over, usually because they're just too complex for a quick soundbite. I like to call these the media blackout flags. Here's your first major green flag. Vivmark boasts a really solid 4.4% annualized dividend yield. And look, for a multifamily REIT, providing steady, reliable income is the name of the game. Furthermore, S&P Global recently upgraded the combined entity to an A rating, which really reflects confidence in their sheer scale and stable operating results.
But all right, prepare for a bit of whiplash here, because here is a terrifyingly high red flag, a 122.17% dividend payout ratio. Yep, you heard that right. Statistically, they are paying out, well, actually, it literally means they are paying out more in dividends right now than they currently earn in net income. Now, while REITs do often use adjusted funds from operations to cover dividends, seeing a GAAP payout ratio this high is a stark warning sign about the long-term sustainability of that attractive yield if their earnings don't aggressively scale up post-merger.
On the other hand, the smart money seems completely unbothered by this. Another massive green flag is their 92.68% institutional ownership. This means hedge funds, pension funds, and major asset managers hold the vast majority of the shares. When institutions back a company this heavily, it's typically a sign of deep structural confidence in the management team's ability to navigate the complex integration ahead.
Yet, my forensic audit uncovered one final, really deep red flag, a quick ratio of 0.19. This is a liquidity metric that compares highly liquid assets to short-term liabilities. At 0.19, it indicates severe potential short-term liquidity stress. Think about it. If the credit markets were to suddenly freeze up, this metric suggests they might genuinely struggle to meet immediate cash obligations without tapping into those revolving credit facilities we mentioned earlier. It's a major hidden risk the media is entirely ignoring right now.
Part 4. Fundamentals Reality Check.
It's time to adapt Wall Street's valuation methodologies to the actual metrics right in front of us. So the crucial point is the gap between today's reality and tomorrow's forecast. Based on the market data, we have a current price hovering around $63.68. But look at the Wall Street consensus. The average analyst price target is $71.40. That implies a forecasted upside of over 12%. So on the surface, the model suggests there is genuine value to be unlocked here.
But there is a glaring contradiction here. Despite that 12% price target upside, the actual consensus rating from those same analysts is a hold. Out of 23 analysts, 14 are telling investors to just hold, 8 say buy, and 1 says strong buy, 0 sells. So basically, the majority of Wall Street is sitting firmly on the fence, waiting to see if Vivmark can actually deliver on those $125 million in synergies before they commit any new capital. We can actually apply a Peter Lynch reality check to this. The legendary investor Peter Lynch popularized the PEG ratio, price to earnings growth. He believed a fairly valued company should have a PEG ratio of roughly 1.0. Well, Equity Residential's current PEG ratio is sitting at a sky-high 5.18. By Lynch's standard, the stock appears vastly overvalued relative to its near-term earnings growth potential. It heavily challenges those bullish Wall Street price targets and strongly suggests the stock is currently priced for absolute perfection.
Part 5. Final moat and verdict.
So we've audited the debt, we've uncovered the hidden flags, and we've stress-tested the valuation. The complex reality of Vivmark Residential comes down to 3 main things, and this brilliantly illustrates our synthesis. First, our valuation verdict is decidedly mixed. It is richly valued based on that 5.18 PEG ratio for sure, but that premium is heavily supported by the 4.4% yield and incredibly strong institutional backing. Second, the economic mode. I classify this as efficient scale. By combining 180,000 units, they have created a platform so incredibly massive that it deters new entrants from ever replicating their operational and technological efficiencies across these major coastal markets. Finally, the takeaway. You really have to weigh the reality of absorbing nearly $19 billion in adjusted debt against the sheer, undeniable quality of this coastal asset base. It is a dominant force, absolutely, but one that requires flawless execution from management to overcome that $750 million in integration costs.
So here is where I leave it to you. The models are pointing one way, but hidden flags suggest a storm. Which side are you on? Do your own homework. Let me know what you think of this mega merger, and I'll see you in the next explainer.